Welcome. You're watching India Decides 2024. While we all know it's been tough for the public markets, of course, in trade yesterday and today, but let's get some perspective on what this means for private markets with the election outcome that we saw. Joining us today are two stalwarts of the industry, Rahul Bhasin of Barings Private Equity Partners India and Manish Kejriwal of Kedara Capital. Thank you, gentlemen, for joining us this morning. Manish, I know it's really late at night for you in New York, but thanks a ton for taking the time out. I'll start with you, Manish. You've, of course, been tracking very closely what's happened over the last 48 hours back home. How will capital deployment in India change now in light of the recent developments on the political front? Does the investment horizon go through a considerable change in the next couple of years with the changes on politics, policy, if there is any anticipation on that?
Samina, thanks for having us. Pleasure to be here. All I would say is, unlike most other people on your show, I think Rahul and I are probably more long-term oriented. So I don't think many of our plans have changed overnight, given the results of the election. And let me just emphasize, I think the election is a huge, huge win for Indian democracy. The fact, irrespective of whatever results come out, I think the fact that you chose who you did in Maharashtra and Kashmir, the people got their point of view. Of course, there are lots of good news for the markets with the continuity of the government. But, there's also going to be some weaknesses. However, I want to reemphasize that as private equity, we have a much longer focus, right? It's more a 5 or a 10-year focus. And I would say the only thing that changes in the short term, I would have said if the exit polls were right, we as investors would have spent maybe 60 to 70% of our time driving exits this year and a shorter amount of time, given the higher valuations, doing new investments. So I'd say 60, 70% exits, 20, 30% with doing investments. I think given what the final result will be and assuming the NDA forms the government with the current leadership at the helm, I would say the valuations which have been corrected, and there could be future corrections, we will probably spend as much time looking at new opportunities given a corrected valuation environment. There's already a lot of capital and dry powder waiting on the sidelines, but I think many of us have decided to go a little slow in terms of fresh deployment given where the valuations were. If the valuations, which are corrected, correct further, you'll see greater activity in the deal flow.
Fair point, Manish. And Manish, Rahul, I'll pick up from what Manish said. And he said, while the long-term outlook, and this is also what Bain has said, on India continues to remain very strong, where do you see deal activity in 2024? Do we go back to the kind of levels of deal activity we've seen in 2021, 2022? Of course, the context now is a potential change in policy continuity in that sense, geopolitical risk, which is more global in nature, elevated interest rates, and of course, a general uncertainty and sluggish GDP growth, at least outside India. What do you feel 2024 is going to look like in terms of deal activity?
I think that, like Manish said, we are fairly long-term investors. So most of what happens on a day-to-day basis actually doesn't impact our decision-making too much. Now, will it make any impact? Will it make any change? I'm not sure. I think the only real concern I would have is that if, because of coalition politics, there is an imperative to stray from the path of fiscal consolidation, which the government has embarked upon, I think that might be a concern or a worry. I also think that if there is any lack of decision making or the focus on making India getting diluted in some way, I think again that would be a bit of a concern from a longer-term structural perspective. Will it impact our exits or our entry into particular transactions in the next 12 months? I really doubt it. I think the real issue is that, look, our industry, like all other industries, have a degree of cyclicality. And I think that whenever valuations become stretched or high, and I think that they have been in the market, I think one of the reasons why you saw such a sharp sell-off yesterday was I think the markets have been quite pricey. So if you look at ratios of market cap to GDP, etc., we are amongst the highest in the world. If you look at things like cyclically adjusted PE ratios, again we are almost 2 standard deviations above the norm. Maybe the large caps are not that much, but the mid caps definitely, we are way in excess of the norms. And I think that we tend to stray more towards the mid cap end of the market in terms of the deals that we do. And I think that therefore, opportunities have been a little bit more pricey. The other thing that one mustn't forget is there are challenges in various parts of the world. Therefore, money to emerging markets is likely to be spotty or even reduce. We are roughly a fifth of the private equity market of Asia Pacific. But if the entire Asia Pacific pool were to reduce, we would see consequences of that too. The only other thing is that probably the impact will be dampened because there's a lot more of domestic capital flowing into this asset class now than there has ever been. So again, all in all, I would say it's business as usual. I think with minor tweaks and turns, I think that maybe there was a possibility and an expectation that there would be a lot of deal flow because of divestments taking place. I'm not quite sure whether that would hold anymore under the current circumstances. The focus on sustainability, circular economy, these kinds of things which the government was taking, I hope these things don't get diluted because again, that also affords a big opportunity for us. And it's probably, very good initiatives from the country's point of view.
Rahul, such good points made there, right? We'll of course discuss investee companies in more detail when we speak to you. But Manish, just before we go into that, let's talk about fundraising. You're in New York as we speak. What are investors saying? FIs have shunned the public markets for the last couple of months, citing that India is expensive, there is a China that's available cheaper, and of course, the pool of money in that sense is limited when you're talking about emerging markets. You've had a very successful fundraise. What is the sense you get or got from foreign investors looking at private investing in India?
Samina, I'll be serious on this one. It is a serious topic. I think people had assumed that given what was going on geopolitically in Asia, that the money that was not going to China would flow automatically to India. I can emphatically say that is not the case. That's not the case today. It wasn't the case over the last 12 months. It wasn't the case for the last 6 months when we did a fundraise. Essentially, the money that was going to China obviously has slowed down, but that money from a risk-reward perspective has mostly gone back to the US. A bit of that money will flow into Japan and in India in that order, and that we're seeing that. I think where you're referring to and what Rahul referred to earlier is the funds that have already been raised, not by firms like ours, which are India dedicated, but the Pan-Asian funds, the Blackstone Asia, KKR Asia, the funds that were already raised now have to refocus and swing towards Japan and India. So in terms of money that has been raised already dedicated to the Asia pot, you'll see some of that resulting in greater deal activity in both India and Japan. However, new money to raise, as we've said earlier, 2-3 big complications. Whenever there are issues like Taiwan, like Ukraine and Russia, like what's going on in the Middle East, there is a bit of a flight to safety. The largest market has always been the US. We've seen that in India much more in a pronounced way in the public markets, where the domestic investors through SIPs and others have more or less taken over the role of what FPIs used to do. I think that's a secular change. And I think as a country, we should be sort of thankful for that, given the increased equity participation. I think that can only increase. Right now, it's the retail investor rushing in. Eventually, and I don't know how many years it'll take, But as Indian pensions, the 401k equivalent in the US will soon start switching towards, to some degree, to equities and to alternatives. So I see a significant inflow of domestic capital. Having said that, the majority of the capital that we raised as Kedara was global capital. And there I would say there's only one or two things that people focus on. It's purely past performance, the quality of your team, and your reputation, right? So it's being able to portray yourself as truly a caretaker of someone's capital, ensuring the highest returns from a risk reward perspective, and making sure that your ethos and beliefs shine of very high levels of governance. And you almost play with the moniker that bad news first, right? You're always transparent to your LPs and investors. So I think, to Rahul's earlier point, the global inflows in India have been a challenge for many reasons. I think the best thing that's happened in the last 5 or 6 years in our industry is DPI or returns. We finally have returns going back to our LPs. There's been lots of exits.
Right.
That has created a subtle inflow that will grow over time. But again, to our point earlier, the election results per se don't really change anything, at least where we are expecting it to be right now.
Right.
Obviously, there'll be a bit of a worry on fiscal prudence and deficit management should there be special demands made by different parts of different geographical states. I'll stop there.
Rahul, my question is to you. Ahead of the event, was there a zeal to invest into private opportunities in pockets which are very, very strong on the public markets, defense, let's say capex beneficiaries, etc.? Was there a zeal to invest in the private markets too at those heady valuations? And does this change that narrative? Because the purse is limited, and if the government has to do some bit of welfare spending in order to attract the rural vote, it might go off the total spends that might have been dedicated for capex earlier. If that happens, we don't know that. But therefore, does it bring some other sectors into the fray, into the reckoning, or not quite?
Look, for us, not so much, because to start with, a generic sort of principle of investing is you don't like to invest too much in businesses which have very significant buyer concentration. And industries like defense, etc., have this disadvantage of having predominantly one buyer, and that's the government. And I think that's to my mind, industries which sell into the government have tended to be challenged in terms of generating good returns for investors over any structural, over any reasonable period of time. I think if there are some structural changes in, I think, greater accountability and bureaucratic reform which comes into the country, I think those sectors will become much more attractive. But I mean, there is high growth there, and therefore one will look at things like that. But I think there is also quite a bit of risk. So I think the bar to make those kinds of investments tends to be high in any case. As far as other sectors are concerned, look, I don't think private equity rushes into things and sort of tries to chase the flavor of the season. I think that's classical momentum investing, which is well suited much more liquid asset classes. I mean, our business, Manish and I are sort of at slightly different ends of the spectrum, but essentially what we do is we try and see where the world is going to go, which are the kind of companies which can take it there, and try and partner with them and help facilitate getting to that place. And that helps you have supernormal growth, which is what generates returns for us. I don't think any of those things will change. I don't think any of the trends as far as technology, disruption, etc., are going to change. And those have been very considerable if you think about it the last, ever since the global financial crisis, and with the zero cost of capital, all of that has been very, very substantial. Now, in that situation, there are lots of opportunities. There were yesterday, there are today, there will be tomorrow. I think one of the big challenges to my mind is the fact that a lot of our capital, which comes internationally, I think the big issue is the fact that their own debt to GDPs are high. The ability of some of the countries, including America, to finance its own fiscal deficit is high. And whether we like it or not, the American risk-free rate is the risk-free rate around the world. And if you struggle to refinance your own treasury bills there, they are doing it with short-term capital. I think that that might end up raising risk-free rate for all asset classes around the world. And I don't think India will be exempt from it. And I think that, to my mind, will be the single biggest challenge across asset classes, not just ours.
Okay. Yeah. So, it's open. The jury's out there about how long does it stay that high, and of course. But yeah, Rahul, your point is well taken. That maybe there are other factors barring this election verdict, which probably has a bigger impact. But I'm still inclined, Manish, to ask you this as well. Rahul mentioned no quite changes. You're looking at companies which are taking the world ahead, etc. Are you saying, Manish, for example, that you are not you haven't looked at policy-linked sectors at all in the last 4 or 5 years, and therefore, if you haven't, then it's a separate thing. If you have, does that narrative change at all or no? I understand. I got the broader picture. Just trying to understand and trying to tell our viewers whether this verdict has an impact or no on private markets.
And then basically where we are is not very different from Rahul laid out. Private equity is a very much a bottoms-up driven business. It's the buyer concentration truly worries us also, as Rahul mentioned. But it's not that the election or even a budget every year makes you change your direction. Typically, all of us invest broadly in 4 or 5 different sectors. Within that, people have different concentration. We have been very successful in the whole financial services and consumer play, both direct consumer plays such as retail, where we've done it, or indirect retail plays such as packaging. I think when you understand sectors like this very well and you identify the drivers of success, who the winners and losers might be, you don't go around and changing that opportunistically in the short term. It is true in the last 3 or 4 years, and we also tend to shy away from those businesses which are heavily regulated or which have a high degree of government involvement, just because there are many other players out there, maybe not in private equity, who would have a much bigger competitive advantage. So we would rather shy away from those businesses which need a degree of influence in Delhi otherwise, and remain bottoms up. I think that focus, really knowing the sector better than most others, is why investors give you the capital and you focus on what you know well.
Right.
So
Right.
I would say the momentum part of this swinging is something we try to avoid, remain long-term focused. And in times like this is even more when you return to your basics, you sort of go back to your list of wishful, these are the 8 or 10 companies we really liked. Maybe 5 of them were out of the zone because of valuation reasons. And you try to make a new play, a new value proposition. Given the broader environment, the pressures, will these come down, even in the private markets, to levels that you feel comfortable investing behind? It's not to say that in case what the exit polls have suggested, that all of us would go away from consumer, from financial services, from healthcare, from tech and tech services, and suddenly start doing things like defense only.
Rahul, one quick question. While some may have argued that it's been a funding winter for Indian startups, it's been a marquee year for Indian exits. And IPO has been a preferred route given the euphoria we've seen in public markets. Do you feel, Rahul, that sentiment still remains with everything that we've been seeing and talking about and hearing about with Indian equity markets?
See, I've always held that high quality businesses always have buyers, whether in the public markets or private markets. I think if you have a decent business and it has a decent growth trajectory with decent return on capital employed, you'll always find buyers. And I think that that's really not an issue. I think the buoyancy is still very much there in the public markets. I think lots of issues will go through, because if you look at the sum total of capital coming into public markets and you look at the issuances or the capital being raised out of public markets, I think the flow of capital coming in is still much higher than the aggregate amount of issuances, whether it's from secondary or primary. And as a consequence, I think the public markets will continue to stay well bid, at least for a while. I think, of course, if people overprice their issues and, what tends to happen in situations like this is that a lot of momentum plays get bought into, often by people who don't quite understand them. But that's the nature of human beings, and that's the cycle of greed, and I would call it more than greed, just envy. And then people get burnt, and I think that's a cycle which has repeated itself always in markets and will do so even this time.
Thank you, Rahul. Thank you, Manish. Great getting both your perspectives and, of course, explaining to us what it really is for a private sector, private investments, as opposed to the reaction we're seeing across public markets over the last few days. Thank you. Have a good time in New York, and of course, good luck, and we'll hopefully see you soon. With that, we're completely out of time on this edition of India Decides, but stay tuned. There's a lot more programming on the other side. We'll talk to F&O guests to get a sense of what's happening in the derivative market.